You've seen the headlines, right? Some hot new tech startup is suddenly worth more than a giant century-old company. But what does that big number they splash on the screen, the market cap, actually tell us? Well, today we're going to pull back the curtain and find the real price tag of a company, and you'll see why that headline number is often just the tip of the iceberg.
And to do that, we're going to start with a puzzle, one that really stumped a lot of people back in 2020. It's a classic David versus Goliath story, pitting a company that basically became an overnight sensation against an entire industry that was, well, literally grounded.
So here's the central question. Was Zoom, the video chat company we all got to know very well, actually bigger than the 7 largest airlines in the world combined? I mean, on the surface, that sounds completely absurd, but it's what all the news reports were saying.
And those headlines were all based on this one single number, market capitalization. And if you just look at the data, you can see why they ran with it. In 2020, Zoom's market cap just exploded, blowing past the combined value of giants like United, Delta, and American Airlines. But this picture, as we're about to find out, is really misleading.
To solve this puzzle, first, we've got to understand the number that everyone loves to quote, market cap. And honestly, the best way to think about it is as the very visible tip of a much larger, hidden iceberg.
So what is market cap? It's actually super simple. You just take the current stock price and multiply it by the total number of shares that are out there. That's it. It gives you the total value of the company's equity, basically the part the shareholders own. It's the number you see on every finance website, but it only ever tells you part of the story.
Which brings us right back to this iceberg idea. If you only rely on market cap, you're literally just seeing what's floating above the water. You're completely ignoring the massive and frankly more important stuff that's hidden underneath.
So how do we see the rest of that iceberg? Well, we use the tool that professionals, the folks doing mergers and acquisitions, rely on every single day. It's called enterprise value. And this is the real price of a company.
Enterprise value, or EV for short, is just a much more complete way of looking at things. Think of it like this. It's the theoretical takeover price. If you wanted to swoop in and buy the entire company, the whole shebang, lock, stock, and barrel, EV is the number that you would actually care about. It's the value of the entire business engine.
And this house analogy makes it perfectly clear. Ignoring a company's debt is like saying that this $500,000 house is only worth $100,000, just because that's the owner's equity. You're completely forgetting about the massive $400,000 mortgage. You just can't ignore the debt. So, how do you figure it out? It's actually really logical. You start with the market cap. That's our tip of the iceberg. Then, you have to add all of the company's debt. Why? Because if you buy the company, guess what? That debt is now your problem. But then you get to subtract any cash the company has sitting around, because hey, that cash becomes yours, and it effectively makes the deal cheaper for you.
Okay, so this isn't just some abstract financial exercise. For anyone making serious decisions about money, enterprise value is the absolute gold standard. And there's a really important reason for that.
The key phrase here is that EV is capital structure neutral. Now that sounds a bit jargony, but all it means is that EV doesn't care how a company is financed. Whether it uses a ton of debt or issues a lot of stock, EV cuts through that noise and focuses purely on the value of the actual business operations. It can't be easily fooled by financial tricks like share buyback.
And this table is where it all clicks. Look at this. We've got 3 companies that, based on their market cap, look identical. They're all worth $4 billion. An investor could make a huge mistake here. But enterprise value tells the real story. Company C, with all its debt, is actually a 30% larger operation than Company A. It simply has more assets funded by capital working to generate profits.
And this way of thinking changes how we compare companies, too. A lot of people love the price-to-earnings, or PE ratio, but it's flawed for the same reason. It only looks at the equity part of the equation. The much better metric is EV to EBITDA. This compares the total value of the firm, its enterprise value, to the total earnings available to all the investors, both debt and equity holders. It's a true apples-to-apples comparison.
All right, so now that we have this powerful tool in our belt, let's go all the way back to our original puzzle and finally see the whole picture. The solution was hiding in their business models the whole time. The airline industry is what we call asset-heavy. They have to take on massive amounts of debt to buy their fleets of airplanes. So in 2020, even though their stock prices got crushed and their market caps tanked, their enterprise value, which includes all that debt, was still enormous. Zoom, on the other hand, had almost no debt. The moment you looked at the whole iceberg, it was obvious the airlines were still vastly larger operations.
So, let's just recap the big takeaways, shall we? First, remember market cap is just the equity. It's only the tip of the iceberg. To see the whole thing, you need enterprise value. And to get that, you take the market cap, add the debt, and subtract the cash. And most importantly, it's EV that lets you make a real, fair, apples-to-apples comparison between any two companies.
So, the next time you see one of those screaming headlines about a company's incredible value, just take a second, pause, and ask yourself, am I really looking at the whole picture? Or am I just seeing the tip of the iceberg? Thanks for joining me.